Well, hello and welcome to Moneycontrol. You have tuned into IPO Watch, and I'm your host, Nikki Mirchandani. It's a bit of earning profile coming in for a newly listed entity out there, Protean eGov Technologies. Well, it's just reported in numbers for the September quarter. We're looking at a 32% uptick when it comes to the revenue year-on-year basis for the quarter, and the profitability too seems to be higher by as much as 27.6%. Margins have remained flattish around that 15-16% mark thereabouts. But to know more about the financials of the company, we're being joined by the managing director and the CEO of the company, Suresh Sethi, who joins us now to provide us valuable insight about the basic functioning of the numbers first. Hello there.
Hi, Nikki. Good morning. How are you?
Good morning. It was rather, I would say a lackluster start to the IPO with the company listing at par with the issue price. But the numbers seem to be fine enough in terms of just your top line growth, 32% growth on quarterly basis. And for 6 months basis, we're looking at a number of 36%. Explain us what goes behind the making of top line numbers and also a revenue split of the two divisions that you have.
Sure. So, Nikki, as you said earlier, the company has been strong in contributing to digital public infrastructure in the country. The three large assets which we have today is in the space of taxation, social security and welfare, our pension services business, and likewise the digital identity services that we provide on the back of India Stack. So these are the three large contributing businesses other than the new line of businesses we are putting up. And over here, the growth I will strongly attribute to a great, forward-looking for rather great business drivers coming through in the space of taxation, where clearly we have seen growth in terms of the number of tax IDs issued. So one, there has been overall growth in the number of tax IDs issued. And secondly, we've also consolidated and improved our market share in that line of business. So that has been one contributor to the strong growth. The second area is in the space of digital identity, which is very much aligned with the Digital India progression as we see, where the digital economy is growing at a good, healthy 2.5 times better than the normal economy. And that is where we've seen more accounts getting opened, more digital transactions being done. So all the parameters on e-sign, e-KYC, e-authentication, and online PAN validation, which ultimately enable you to open a bank account or to do a digital transaction in the financial services space, have helped us to achieve these numbers.
Sure. If you could provide a further revenue contribution of each of your segment, at least for 6 months, just to get a flavor of how we are heading and shaping up, at least when it comes to the transaction fees. The last time we spoke, I remember you telling me that the numbers in 2021 were 75%, which have picked up to 78.67% as of 2023. Now, for the first 6 months of the present financial year, how much is the contribution overall?
So the numbers are around similar numbers. So both transactional revenues have definitely grown, but considering the large base, the annuity numbers remain almost the same. So as we mentioned to you last time, pension is the line of business where we are acting as the central record keeping agency for the National Pension Scheme and the Atal Pension Yojana, where we have an annuity component in our revenues, because one part is the transactional fee we get for every account opening. And the second part is whatever we are maintaining as the pension database, we get an annuity earning on that. So that is the annuity portion. The businesses I referred to where I talked about earlier in taxation and in identity, they are all transactional businesses. So the revenue mix or the revenue split between annuity and transactional remains almost the same.
All right. You expect that to maintain around that 78 to 21% level? 78.67 for transaction and roughly around 21% levels thereabout for account maintenance?
Like I say, ultimately, the transactional revenue is the incremental business we get for every new transaction done. And when we look at annuity, the annuity is basically a growing pool, because at the end of the day, as more pensioners are subscribing, it's adding to the baseline. And that naturally becomes something which will grow over a period of time consistently because of the increase in the base. So historically, we've seen a trend. Naturally, annuity has grown because as you have more and more pension subscribers in your database, those revenues will keep on growing. But we've also seen that our transactional revenues have kept a good pace because, as I said, most of these are DPI related transactions, and there also we've seen a strong growth. So difficult to predict what will be the mix because I see both of them growing. One will grow on an annuity parameters, and the other side will clearly be transaction growth. Because even as we compare between our last half year and this year, there is strong growth in the transactional revenues because of more transactions getting done. And likewise, the pension database has also grown, and therefore that contributes on the annuity side.
Sure. I was also looking at the revenue profile. If you could provide us with some amount of guidance there. The revenue as of 2023 was 742 crore. But if you look at the numbers that you provided for 6 months, and if they were to be analyzed, we're looking at a number of roughly 900 crore on the top line and a profitability of nearly 130 crore, implying a top line and a bottom line growth of nearly 20%. Is that the right way to look at it?
If we do a multiplication, yes, but let me put it differently. I would definitely say that the growth in revenues, as you also earlier called out, the revenue from operations year on year have grown by 36%. And similarly, when we look at the net profits or the EBITDA, first of all, EBITDA has grown by 25% as we do the year on year comparisons. And we expect the strong momentum to continue.
So the second half, do you expect faster growth in terms of your revenue as compared to what you've delivered in the first half? How do you expect the performance to stack up? And overall, what is the number of growth you're targeting by the end of this financial year?
So let me put it this way, that there is a certain momentum which we see out there because as compared to last year, clearly, as I mentioned, the number of cards issued, for example, in this part of the year has been significantly higher than last part, and that is what is directly contributing into the transactional earnings. So clearly, there is a underlying strong momentum. Digital identity transactions have grown, which again, in a way, is a reflection on how the market has grown, which technically means when I translate it, ultimately more accounts have got opened in the BFSI ecosystem. More digital transactions are happening because as we see with more penetration of UPI, with more people doing those transactions, all this is leading to the growth. So the transactions, as we see, there is a certain uptick from what the numbers were last year. We expect that to continue to be there because it's a larger macro phenomena.
Sure. Also, in terms of your margin profile, thereabouts, it's remained around consistent around that 15-16%. Rather, let's just say it's got a dip there in this quarter. How are you looking at it? Do you kind of expect the margin performance to continue at this level itself here on? And if you expect a better performance, what kind of growth drivers can we be looking at for the margin?
So, Nikki, you'll see the margins have largely been flat, which technically doesn't reflect because end of the day, margins are just an outcome of revenue and profits. So what we are saying is there's a strong revenue growth, the profits have grown, but when you do the division between the two, it's come to a number which is consistent, or as you otherwise mentioned, it's slightly down. The slight downward trend is because of the investments in new businesses. As we had discussed earlier, we are now diversifying, we are moving beyond tax, identity, and pension. We've invested into building new open digital ecosystems across multiple sectors, which is ONDC being one, digital commerce and mobility, then agriculture, health, education. Similarly, we are building a data stack on top of our foundational services of identity, where we are looking at more data analytics and digital onboarding, along with the account aggregator license the company has. And likewise, we are looking at foray into international markets. So some of the early investments in building the new businesses have come in, where you see a slight downward tick in the margins, but otherwise the margins continue to be healthy and overall growth is there in revenue terms and in profit terms.
So can we expect a 20% growth by the end of the financial year when it comes to your top line performance at least?
I would say there's a healthy momentum as we see it where we are today. I will not put a specific number as a forward-looking statement, but the momentum is there, and our half-year numbers we clearly see. See, again, it's not a concentrated business; it's a very granular business. There are more transactions happening month on month, and we expect that momentum to definitely carry forward.
So, between the two of your division, if you can help us understand the margin difference between the two. And of course, one division which apparently in this quarter, from this quarter and onwards, is picking up more traction. How are the trends essentially shaping up for Q3?
So see, underlying each business in a way is different, because when I look at our taxation business, the taxation business also has a huge physical network which supports it. So as we mentioned earlier, the company has a huge distribution network of almost 160,000 plus physical touch points across the country, where we also provide assisted services. So when we look at the margins on the taxation business, they also take into account the revenue sharing, which is done with the last mile service provider who's enabling somebody to apply for a PAN card or get onto the issuance side. If you look at a business like pension, over there we have very limited, sharing of revenues, because largely the business is run on a database on technology which has already been created, and a consumer comes directly on board through a point of presence network or directly using one of our apps. So clearly, the margin profile of the businesses is different. Identity business is again a business where the underlying technology is out there, the scaled infrastructure is in place. So every incremental transaction done has a low sharing in terms of with the ecosystem or with direct expenses, if you may. So contribution margins across all three businesses are different. The highest being the identity and the pension business. And in the tax business, naturally, there is more sharing with the assisted network in that case.
All right, Mr. Sethi, we're just going to leave it at that. And thank you for taking out the time and having a conversation.
Thank you so much.